Chapter 10, Plant Assets, Natural Resources, and Intangibles. Plant assets are sometimes referred to collectively as property, plant, and equipment, or PP&E. Plant assets are long-lived, tangible assets used in the operation of the business. These assets include land, buildings, equipment, furniture, fixtures, and automobiles. When these assets are acquired, they are recorded at cost in accordance with the cost principle. Generally, the cost consists of acquisition plus all costs necessary to get the asset in place and ready for its intended use for the business. The cost of land includes the purchase price, brokerage commissions, survey and legal fees, delinquent property taxes, title transfers fees, the cost of clearing the land, the cost of removing old buildings from the land. Land is a unique kind of plant asset that is never depreciated. The cost of land does not include fencing, paving, sprinkler systems, lighting, signs, and other improvements to the land such as landscaping. These costs are collectively referred to as land improvements. These costs are separately identified from the land itself, and they are depreciated. Assume that Smart Touch Learning buys some land on August 1st for $50,000 and pays for it with a note payable. Other costs related to this transaction include $4,000 in delinquent property taxes, $2,000 in property transfer taxes or fees, $5,000 to remove an old building from the site, and $1,000 for a survey of the property. What is the cost of the land on Smart Touch Learning's books? As you can see from the computation in Exhibit 10-2, the cost of the land is not only the acquisition cost of $50,000, it also includes the additional $12,000 of costs that bring the total cost of the land on the books up to $62,000. Now, prepare the journal entry to record the acquisition of the land. The journal entry to record the acquisition of the land would include a debit to land for $62,000 and credits to notes payable for $50,000 and to cash for $12,000, related to the additional costs. A company can acquire a building one of two ways. The building can be constructed, or a finished building can be purchased. When a building is constructed, the cost of the building includes the excavation of the site to prepare for the construction of the building. In addition, architectural fees are included in the cost of the building. Other costs include building permits, contractor charges, materials, and labor. When a building is acquired, the cost includes the purchase price, any brokerage fees and delinquent taxes, and any renovation costs necessary to prepare the building for occupancy. The cost of machinery and equipment and furniture and fixtures includes the purchase price, any purchase commission, transportation costs necessary to get the equipment to the site where it will be used, installation and testing costs once the equipment is on site, insurance on the equipment while it is in transit, and any sales taxes on the purchase of the equipment. Sometimes a company pays one price for several assets. This is sometimes called a basket purchase. Accounting principles require that companies must assign a cost to each uniquely identifiable asset that is acquired. In the case of a basket purchase or lump sum purchase, the total cost must be allocated to each of the assets acquired. This is accomplished by allocating the cost to each asset based on its market value relative to the total market value of the assets acquired. Smart Touch Learning paid $100,000 on August 1st for land and a building. The $100,000 must be allocated, some to the land and some to the building. The land has an appraised market value of $30,000 and the building is appraised at $90,000 for a total market value of $120,000. How much cost should be allocated to the land and to the building? As noted, the total market value is $120,000. The land represents 25% of the purchase and the building represents 75%. Next, we will apply these percentages to allocate the costs of $100,000. In our example, 25% of the cost should be allocated to the land and 75% to the building. This gives us $25,000 and $75,000 respectively. To prepare the journal entry, we do as follows. A debit of $25,000 to land, and a debit of $75,000 to building, with a credit of $100,000 for the notes payable, assuming that the money was borrowed for the acquisition. In the triad example, Budget Banners pays $200,000 for a bulk purchase of land, building, and equipment. The land had a market value of $22,000. The building had a market value of $187,000, and the equipment a market value of $11,000. Allocate the $200,000 acquisition cost to the three assets and record the transaction. The total market value of the acquired assets is $220,000. The land represents 10% of that purchase, the building 85%, and the equipment 5%. The journal entry to record the acquisition includes a debit to land for $20,000, a debit to building for $170,000, and a debit to equipment for $10,000. It also includes a credit to cash for $200,000, assuming that the purchase was made in cash. The plant assets are recorded as assets when they are purchased. Over time, the usefulness of those assets is consumed. To account for the using up of the plant assets, and in accordance with the matching principle, we will need to periodically and systematically allocate the cost of the plant assets from the balance sheet to the income statement. This process is referred to as depreciation. As discussed earlier, the depreciation process is part of the end-of-period adjustment process. Depreciation expense will be debited, and a contra account called accumulated depreciation will be credited. To compute depreciation for a period, we will need to consider three primary factors: estimated useful life, the capitalized cost of the asset, and estimated residual value of the asset at the end of its estimated useful life. There are three common depreciation methods: straight-line depreciation, units of production depreciation, and declining balance depreciation. As we work through each method, we will use the following information. Smart Touch Learning purchases a truck on January 1st, 2014. The truck has a cost of $41,000 and an estimated residual value of $1,000. The estimated useful life of the truck is 5 years, or 100,000 miles. Under the straight-line method, residual value is deducted from the depreciable cost and then divided by the estimated useful life of the asset. Straight-line is the most widely used method in business today. The result is that for each year of an asset's estimated useful life, the depreciation computation will be the same for the entire asset estimated useful life. In the Smart Touch Learning example, the depreciable cost is $40,000, divided by an estimated useful life of 5 years. So we got that $40,000 by taking this $41,000 cost and subtracting what it will be worth when it's just scrap, $1,000. That gives us the $40,000 depreciable cost. Divide that by 5 years, and that gives us $8,000 of depreciation per year. So, at the end of 1 year, to record the depreciation for the truck, we will have a debit to depreciation expense for $8,000 and a credit to accumulated depreciation for $8,000. The units of production method requires us to compute depreciation based on how much an asset is actually used relative to its expected productivity over its estimated useful life. This is less predictable than other methods. Assume that in the first year of its use, the truck was driven 20,000 miles. The first step is to compute the depreciation per unit of use. In this case, the asset is expected to have a useful life of 100,000 miles. The depreciable cost of the truck is $40,000 because, again, we said the cost was $41,000 here and the residual value will be $1,000 here. So we're depreciating $40,000 worth of this truck. And we're essentially dividing that $40,000 by the useful life in units, which in this case is miles. So this will tell us that for each mile we drive, we're essentially using up 40 cents worth of this truck's value. In step 2, we compute the amount of depreciation for the current period based on the depreciation per unit of use and the actual use. So we calculated 40 cents per mile. We said there was 20,000 miles used, so that results in $8,000 worth of depreciation for year 1. The fact that this is the same depreciation amount as we saw in the straight line method is merely a coincidence at this point, because if we had driven even 1 mile more or 1 mile less, this number would be different. Because this method is so unpredictable, we have no idea how much depreciation will be in year 2. It could be as much as the entire rest of the depreciable value, or $32,000. Or if the truck is not driven at all, it could be 0. The double declining balance method is called an accelerated method. Although the total depreciation on the asset over its estimated useful life is the same under all 3 methods, or in our example, $40,000, when we use the double declining balance method, more depreciation is taken in the early years of the estimated useful life, while taking less depreciation in the later years of the asset's estimated useful life. The book value of the asset as of the beginning of each period is multiplied by twice the straight line depreciation rate. Each year, the book value of the asset will be lower than the book value of the previous year. For example, in year 1, Smart Touch Learning's truck will have $16,400 of depreciation, compared to only $8,000 depreciation using the straight line method. In year 2 of the asset's useful life, the depreciation will be computed as $9,840. At the beginning of year 1, the book value was $41,000. At the beginning of year 2, the book value is now only $24,600 because we took off the $16,400 from depreciation in the first year. We will continue to change the book value of the asset each year until book value reaches the estimated residual value. Once book value reaches residual value, we cease computing any additional depreciation. At some point, a plant asset will cease to be useful. Perhaps it is obsolete, or it is just so old that it no longer runs efficiently. Whatever the reason, a company will discard previously useful long-lived assets. When that happens, the asset must be removed from the books. In addition, any accumulated depreciation related to the discarded asset will also be removed from the books. If cash is received from the discarding of the asset, it may be necessary to record either a gain or loss on disposal of the asset. In this first example, we will examine a case of a simple retirement of a long-lived asset. It is not to be sold. Rather, it is being discarded, not to be used any longer. Smart Touch Learning discards equipment that costs $10,000. The accumulated depreciation of the asset is $10,000. In other words, the asset is fully depreciated. There is no cash involved in this transaction. The journal entry to record depreciation for the period will include a credit to equipment to remove its original cost. In addition, a debit to accumulated depreciation will remove the related balance from the books. Because there is no cash involved, this journal entry is now balanced. In the second example, Smart Touch Learning discards equipment that costs $10,000. Unlike the previous example, the asset is not already fully depreciated. Because the asset sold in the middle of the year, we must compute and record a half year's depreciation before recording the asset's disposal. The asset already had $8,000 accumulated depreciation. There is no cash involved in this transaction. First, we have to compute the half year's depreciation. Depreciation for a half a year is computed as the normal annual depreciation times 1/2. So in this case, $500. The entry to record the depreciation is a debit to depreciation expense for $500 and a credit to accumulated depreciation for $500. This will change the accumulated depreciation balance from $8,000 to $8,500. Second, we need to record the disposal. The entry will require a debit to accumulated depreciation for $8,500 and a credit to equipment for $10,000. The difference of $1,500 is debited to loss on disposal. In the third example, on July 1, Smart Touch Learning sells equipment for $4,000. The equipment originally cost $10,000. As of the previous December 31st, the accumulated depreciation on the equipment was $8,000. Annual depreciation expense is normally $1,000 per year. This is how we would prepare the journal entries for this transaction. First, because 6 months have passed since the last recording of depreciation, we must make an entry to record depreciation from December 31st to July 1st, 6 months. The computation is 1,000 times 1/2, or 6/12, giving us $500. The entry to record the additional depreciation will require a debit to depreciation expense for $500 and a credit to accumulated depreciation for $500. This will bring the accumulated depreciation balance to $8,500. Next, we need to record the entry to record the sale of the equipment. The entry includes a debit to cash for the amount of cash received, $4,000, a debit to accumulated depreciation to take that account off the books for $8,500, and a credit to equipment for $10,000 to remove the equipment from the books. At this point, the journal entry is not balanced. We have $12,500 in debits and only $10,000 in credits. To make the entry balance, we record a credit to gain on sale of equipment for $2,500. In addition to long-lived assets, there is another type of asset referred to as natural resources. Natural resources are like inventory because we will sell them. However, they are also a long-term asset that will take years to extract from the environment. Natural resources include iron ore, oil, natural gas, coal, timber, diamonds, gold, silver, and other important minerals. When the right to extract natural resources is acquired, the acquiring company will record the cost of the reserves as a long-lived asset. As the natural resources are extracted, we have to move part of the cost of the reserves to the income statement. This process is called depletion. Depletion expense is computed based on the units of production method. A cost per unit of resource is determined based on the cost paid for the reserves and the estimated amount of reserves available to be extracted. Once we determine the amount of resources extracted in a period, we can multiply that by the depletion expense per unit of natural resource to arrive at depletion expense. The other side of the entry will be a credit to accumulated depletion. A company acquires the rights to 70,000 estimated barrels of oil for $700,000. During the year, 3,000 barrels of oil are extracted from the reserves. The depletion per barrel is computed at $10 per barrel. This you see right here, cost 700,000 minus residual value 0, divided by number of barrels, or number of units, 70,000, which is the estimated reserves. That gives us our $10 per barrel depletion per unit. In step 2, we will multiply the depletion per barrel of $10 by the number of barrels extracted during the period of $3,000 for a depletion expense of $30,000. Now record the journal entry to record depletion expense. The entry requires a debit to depletion expense for $30,000 and a credit to accumulated depletion for $30,000. In this triad exercise, Amplify Petroleum has oil reserves of 100 million barrels. They paid $80 million for those reserves. This makes the depletion per barrel 80 cents. During the year, Amplify Petroleum extracts 20 million barrels of oil from this site. The amount of depletion expense is 16 million. This is just 80 cents per barrel times 20 million barrels. The entry will require a debit to depletion expense of $16 million and a credit to accumulated depletion of $16 million. The final group of long-lived assets are called intangible assets. These are assets that have no physical substance. In some cases, but not all, the intangible asset is represented by a piece of paper that cedes ownership of the intangible asset to the owner. In some examples of intangible assets include patents, copyrights, trademarks, franchise agreements, licenses, and goodwill. For purposes of amortization, the life of an intangible asset is usually defined by the shorter of its legal life or useful life. However, only definite life intangible assets are amortized. Intangible assets with an indefinite life are not amortized. Amortization is similar to straight-line depreciation. It basically just means dividing a large dollar amount or money amount into equal payment amounts over a period of time. Unlike the depreciation or depletion processes, amortization does not utilize a contra-asset account to store the accumulated amortization. Rather, as amortization expense is incurred, it is credited directly against the intangible asset. In this triad exercise, Orange Manufacturing paid $40,000 for a patent. The patent has a legal life of 20 years, but it is expected that the actual useful life of the patent will only be about 8 years. Prepare the amortization journal entry for this patent at the end of the first year. Amortization of this patent is a simple computation of cost divided by estimated useful life. In this case, the amortization for the year is $5,000, or $40,000 divided by the 8 years that we estimate this will be useful for. The entry will require a debit to amortization expense for $5,000 and a credit to patent for $5,000. And remember that credit to patent here is the actual asset account patent. So again, as was mentioned before, there's no contra account that kind of holds the total amortization that has gone on and nets it against the value of that. No. This is just going to directly reduce the value of this asset. The asset turnover ratio is used to measure how well a company utilizes its assets in generating sales. It is a simple calculation of net sales after deducting sales discounts, returns, and allowances divided by average total assets. Now, average total assets is the beginning of the period total assets plus the end of period total assets divided by 2. And in this case, you can see that 1.16 is the asset turnover ratio in this example.